So how do I think about this? So I talked about my sort of statistical mindset as it relates to investing in these funds with big dispersion. And it's across GPs and it's across vintages for the exact same GP. So if I invest with you with Ignite and the 2022 vintage is a 4X and the 2025 vintage is a 2X, they might, and I put the exact same amount of money in, then they net out to 3X. But
Right.
you're not netting in terms of your step up and carry. Whereas
Mm.
I am trying to diversify across different vintages and across 45 different GPs. And so to me, I'm not getting your outperformance in one vintage does not necessarily mean you're going to always outperform.
Hey, everyone. Welcome back to the Ignite podcast. Today, we're delighted to have Eric Sippel on the program. He's been around venture capital, family office space for a long time. So we're thrilled to have him. He's a seasoned investor at the Sippel Family Office, years across hedge funds, VC, alts. He brings a unique perspective of managing a family office, investing in niche markets, and advising emerging fund managers. I might know one of those. And thanks for joining us, Eric.
My pleasure. Thanks for having me.
Yeah, thanks for coming. So walk us through the differences of, investing in venture capital versus, a more traditional family office approach.
Well, I think that traditional family offices also invest in venture capital. But
Yeah.
do you mean investing in venture versus other asset classes? So venture, and by the way, just at the outset, if you've met one family office, you've only met one family office, right? I'm not like going to sit here and speak for family offices nationwide or globally. My preference when I invest in venture capital, I think of them as venture capital is divided into separate sort of asset classes within one asset class. And I strongly prefer emerging managers. And I strongly prefer pre-seed and seed, and to a lesser extent, A managers.
Hmm.
So what I'm going to be talking about is in that subset. I'm not talking about investing in A16 or Sequoia or Excel. I'm talking about that universe. And so it shouldn't be sort of broader than that.
Yeah. Well, I love
And the
that.
other
I mean,
thing,
we are an emerging manager in pre-seed and seed. So I'd love to hear, how did you stumble upon that thesis? Because it's not a usual thesis.
yeah, it may not be. And so I'll answer the second question first, and I'll come back to the other one because I think it's sort of relevant in terms of context. So I've been investing in venture funds for more than 30 years. I was, as you said in the outset, I've been in the alternative space for my entire 38-year career. And when I look across asset classes, on the one end, you have public equity or fixed income, I suppose, publicly traded fixed income, where there's very little dispersion among managers. It's very hard to stand out. And for the most part, you might be just better off investing in index funds for the most part. Then, and you sort of go through various asset classes, whether it's commercial real estate or natural resources. These are private via alternative vehicles or private equity or venture capital. And you sacrifice liquidity, but you get more dispersion from the mean. In the emerging manager venture capital asset class, you get by far the most dispersion. And as a result of that, if you are good at choosing within that sub asset class, and I have deluded myself into believing I'm good, but if you believe you're good at that, you can drive truly outsized returns.
Yeah.
And so if you have, and I'm just going to talk about my portfolio, I'm an investor with investing capital with 45 different venture firms, hundreds of venture funds, 45 different firms across many asset classes. And when I say that, I mean emerging managers, again, in that, or they have emerged, but I invested with them first when they were emerging. Everything in investing is a combination of luck and skill.
Right.
But if I look at my portfolio, I'd say 2/3 of the portfolio is in top quartile VC, and almost all of the remaining third is top half.
Nice.
And so that drives significantly
Now,
better
is it a bell
returns.
curve? I mean, is it a bell curve around the mean? Or is it kind of like a power law distribution? I know within startups, it's a power law, right? It's a outsized,
Yes.
that top 2% is going to drive 80%. But is it the same
So,
with fund managers?
well, I think there is, but again, my portfolio has now shifted in. So there's a bell curve, but I'm only taking the right side of the bell curve.
Yeah. So there is a dispersion, a bell curve around the mean, kind of
There
it
is a
follows a normal
massive,
distribution.
yes, there is absolutely that. You just have to be lucky and good enough to try to get to the right side of that.
Right. Right.
But if you do, so far I have, um, that drives significant returns that far exceed whatever illiquidity premium that you are paying.
Yeah. And I think I know some of these stats, but for the audience, what is the difference between kind of the different quartiles? You kind of mentioned like, hey, we have a, 2/3 in the top quartile and then nothing in the bottom. And
It
then,
obviously
yeah.
depends on vintage year,
Mhm.
but I think of greater than X net to the LPs as being top quartile. Maybe it's 2.75, but 3 is kind of where I think of it. And I think of top half as greater than X. Bottom quartile is maybe less than 1X.
Wow. So only
Um,
returning basically principal back.
Bottom quartile, I'm saying, is returning less than principal.
Wow. That's incredible. And if you think
Yeah.
about the mechanics of a venture fund, just, for the audience who may not know is, it's usually 2 and 20, right? So you got the
Yes.
2% a year. So over 10 to 12 years, that's, 20% right off the top. Then you got the 20% of profits typically. Sometimes that escalates. And then, so if you're talking about a 3x net, you're really talking about a 4x gross,
I'm
roughly.
thinking 4.2 gross.
Yeah, something like that. And that's
Yeah.
because you have other fees too. It's not just the 2 and 20, but you have all the formation expenses and the, all the taxes and the fund admin and all that stuff.
Yeah, I think about 22% of a commitment goes, 20 to 22% goes to all of that stuff before you get to carry. Now, of course, recycling changes that a little bit, but we'll park that for the moment. But one thing I want to get back to, the first question you asked before we got down this other path was around, which I partly answered, about in terms of asset class and how I think about it and how I think about emerging manager, sub $150 million venture funds, and how I think about it as a family office. And one of the things that I think that too many LPs don't really think enough about is the duration of the fund. And so it will take 12 to 15 years to get almost all of your money and returns out of a seed stage venture fund.
Yeah. We call them 10-year
You
funds, but in practicality, it's 12 to 15 because you usually extend them and then you have to roll them up or sell them off.
Yeah, exactly. And whatever LP you are, it could be a family office, it could be an institution, it doesn't matter. You need to know that you're signing up for getting your money back maybe in the first 10 years at some point, but real returns in years 10 to 15. And
Wow.
it may be, you may have, that may change for a specific fund occasionally, but that's kind of what you're signing up for. And so if that's not what you're willing to sign up for, don't invest.
It's the liquidity lockup. You're getting outsized returns on average for this asset class, but you are also getting outsized liquidity risk where your money's tied up for 10 to 15 years.
Yes. Yes.
So how did you stumble upon this thesis, this niche of investing? Because it's not something that I think now people can discover it. You have YouTube, you have podcasts like ours and others and books written about this. But having invested in venture funds for decades, how did you find your way into that?
So to be clear, the sort of thesis that I articulated really, for me, I've only started doing that 12 years ago. So this is a 10 or 12 year thesis. How did I stumble into it? I've always believed that in any asset class in investing, that size is the enemy of returns. That has been my experience as well as my belief.
There's a reversion to the mean that happens, right? When you have the kind of the law of large numbers. If you take a huge sample of any asset class, you're going to kind of get to the mean of that asset class.
That is absolutely true. But in addition to that, I just think it leads to sloppiness. If you're managing too much money, your thinking isn't as sharp. Your management fees are driving your decisions rather than your carry. If the business needs a $2 million check, but you have to write $3 million checks, you convince the business to take a $3 million check. Or maybe your ownership, you compromise on valuation because it just doesn't matter. There's like a lot of stuff that goes.
Little things. You have a $500 million fund. I mean, you start thinking about deploying that. We like to invest in about 100, 150 startups per fund. Now you're starting to talk about $5 million checks just to deploy. And if you think about it, like if you're a pre-seed and seed investor like we are, you can't even write $5 million checks in those rounds. These founders don't need that kind of money. They need 500K, a million or two. So now you're a Series A investor. Congratulations. And you don't know what you're doing, right?
Correct.
Because you haven't done
100%.
you haven't done that kind of investing before.
Right. So yeah. So that's part of it. That's part of how I got there, which is size. I have been my arc of my career. I started off as a Wall Street lawyer working with our firm's private equity fund clients. I moved out to the West Coast in 1990 and spent 10 years co-leading a nationally recognized hedge fund law practice and a venture capital practice. Left to become the chief operating officer of a spin out for Roberts and Stevens. Robbie was one of my clients.
Oh yeah.
And was the COO for 10 years and then been doing this for 15. So I've been working with startup managers for my entire 38-year career. And so the other thing, I was lucky enough to leave the hedge fund and not have to work for anybody else ever again. And not have to get a paycheck anymore. It's pure luck, right?
Isn't it beautiful? It's really beautiful. Yeah.
Probability of me ending up here is close to zero. But here I am. And so what I wanted to do is just give back to the community. And I love venture capital. I love technology. I love startups. And so I was introduced to a few emerging manager VCs, started helping them, invested in a couple, then working your reputation grow. And then I looked up and it was 2016, 2017. I'm like, wait a second, I think I kind of have a thesis here. And then I started, and maybe this is intellectually dishonest. I don't believe so, but maybe it was, I knew what I believed and therefore I went to search for the support as opposed to the evidence sort of bubbling inside of me. But I think I've gotten myself to the place where I really, and I'm not the only one who believes the things I laid out. And so, of course, there's comfort in other people agreeing with you. But that's kind of how I think I got to my thesis.
Yeah. And there are some stats out there floating around the internet around emerging managers. I have a slide or two in my deck.
No, I believe I'm right. I believe there's evidence that shows I'm right. But which comes first? I don't know. It's an evolution.
Yeah, and you said something really interesting, which is the dispersion around the mean is higher with emerging managers, which means the highs are higher and the lows are lower. Maybe you could
precisely
unpack that a little bit.
First, unpacking what it is. If you say that the median return of a venture of a $100 million or sub $150 million venture fund, if you say the median return is X, if you're looking at public equity, 2 standard deviations away might get you to 1.8. Whereas 2 standard deviations away from the median in a venture fund of 1.5 will get you to over 3. Like there's a massive amount, and also on the downside as well. It feels like a bell curve.
Now, do you ever think about like the statistics of this, right? If you remember from statistics class, right? And if you take a sample of a population and you have a small sample, you have a wide standard deviation, right?
Yes.
You have like the error bars are big, and the same is true, I think, of underlying baskets of securities such as stocks or a basket of safes, for these early stage companies.
It depends on as you said, your sample size. If you looked at a basket of securities, but you looked at every price tick of that security, every hour for the last 5 years, you'd have a lot of observations. If you took an observation once a year, you'd have 5 observations. Right. So, it's really about the number of sample observations. But if you look at emerging manager sub $150 million VC funds, we're talking about thousands, 5, 10,000 funds that are existing right now, or firms that are existing right now across vintages. And so there's a fair number of observations at this point.
Right. So how do you go about, you obviously have this massive deal flow because you've been doing that for a long time. Yes. You said hundreds of funds, which is incredible, and at 45 firms. How do you go about diligencing these new emerging managers and screening them?
Yeah. So I have a rubric, a 4 or 5 part rubric, and I'll summarize it. I'm happy to dive into any of the things in more detail. But what it does is it leaves me with a really nice anti-portfolio where firms that don't fit inside of that go on to be really successful. But what I'm trying to do,
you've passed on some of these emerging managers, and you have an anti portfolio that where you're like, ooh, I should have
Absolutely. Well,
invested?
let's start with A16Z,
Oh, wow.
or initialized, or
I've
like
heard, yeah.
really great early, firms at the early stages. And there are plenty of others that
Wow.
are really good, that I've passed on, but there are thousands that I've passed on that haven't been so good. And
Right.
so my kind of thought process and approach is, given the big dispersion, what I'm really trying to do by making my rubric narrow, I'm trying to eliminate the things that I think have a higher probability of being below the median. And therefore, I am eliminating some very good funds, but I'm also eliminating some
Yeah.
bad ones. So what am I looking for? Number one, I'm looking for specialists. I really don't love generalists. And in particular, and this will be exactly the opposite of the way you think about the world, I am
Hmm.
looking for concentrated portfolios, not with high ownership percentages and relatively high check sizes for the size of the fund.
Wow.
To invest. But more specifically, I'm looking for specialists. I prefer in areas where I think there's a big mismatch between opportunity and capital. Said differently,
Now I'm getting why you passed on A16Z, because they're not a specialized fund. They're a very generalist fund.
Well, the other thing, and I pass on them at fund two, and they would never even remember that.
That from the LP perspective, I've heard this before. I've heard the ownership target thing, the concentration, the specialist. Is that because you have to fit it into a larger portfolio, or is it because you think that those kind of funds?
So let me go through Let me go through my entire
Yeah.
rubric, and some of
Okay.
that'll come out. And to the extent it hasn't, push me harder on that.
Okay. Yeah.
So I'm looking for, and by the way, the other reason why I love A16Z, not just because it's a generalist, but also because they become more specialist now, but also because they want to be too large. And I believe in large ownership for small funds, but we'll come back to that. So number one, I'm looking for these sort of areas where there's a mismatch between capital and opportunity. Said differently, slightly inefficient markets. Much, much harder now than it was, say, in 2016 or 17, but
right.
That's okay. Why is it harder now? Because there's way more funds. There's like 10, 15,000 firms, whereas in 2016, there were less than 1,000 seed stage firms. Okay, so that's number one. Number two, I am looking for a GP that has, or GPs that has at least one person, and it could be a solo GP, that has at least 5 years of investing other people's money, not just angel checks, in a manner similar to how they propose to invest my money. So in similar kinds of companies.
So you have basically, stated another way, I've been writing checks with other people's money for 5 years. So you have just some track record. You can look and see, hey, of all those checks, how many are marked up in 5 years? I should be able to see that.
I am looking at what their experience is
in
investing other people's money for at least 5 years. And it doesn't mean they're a spin out of a big firm. As a matter of fact, I tend to avoid spin outs from big firms, but it does mean that they've been investing. Secondly, somebody on the GP team, it could be the same person, has at least 5 years of operating or founder experience in the industry in which, or the specialty. And by the way, when I say specialist, it doesn't have to be industry specialist. It could be specialist in immigration and investing in immigrant founders.
Would B2B SaaS be too general?
No. No, not
so
absolutely
B2B SaaS
not.
would you consider
deep tech, for example, is not too general. I think it takes a specific skill to be a good deep tech investor, a set of skills. And so that's a specialty in my mind.
Okay. So I'm a specialist. I'm B2B SaaS.
Good. No, that's a specialist. Yeah. Absolutely. So
I consider myself a generalist. So I consider that a very general, like half of the startup population that I look at.
Maybe I'm in between the two.
Yeah.
It's nomenclature, right? I'm just looking for someone who has got a specific edge. Third, I'm looking at the 3 S's when I think about an venture capital investor. How do they source and win? How do they select their companies? And how do they steward their companies? Unlike most LPs, I triple click on the stewardship, I double click on the selection, and I single click on the sourcing and winning.
Wow. I'd love to unpack that, but let's get through the rubric. I want to circle back to all these things. There's just so much gold here.
And by the way, the sort of answer your question, well, let me get to portfolio construction as the 4th piece, and then it'll tie it all together and answer one of your questions as to high ownership targets. I am looking for 20 to 25 companies per fund Although if it's a 3 or 4 GP firm, then maybe 12 to 15 portfolio companies per GP per fund. So if you have 4 GPs, then you've got you can have 50
Right.
portfolio companies, and relatively high ownership for the size of check.
Why do you think that's important? Why do you think it's important to only have, 25 companies in a fund?
Because I triple click on stewardship. This is how it ties it
Mm,
all together. Value add. And I double click on selection, which is how much time you spend. I had this thrown at me a couple of weeks ago when a GP approached me and said, "Hey, we had sat down for our initial conversation, and he's like, oh, I listened to one of your podcasts, and so I know the cheat questions. But
yeah.
the big cheat question I have is how long between the time that you first meet a founder till the time that you commit to write a check?" And if that's measured in days or just a couple of weeks, or someone says, well, I usually spend 3 or 4 weeks, but I can move as quickly as 2 days, I'm not interested.
Mm,
From the selection perspective, I believe that your relationship with your investors is a long-term relationship. Remember, it's a 10 or 15, could be a 10
right.
or 15-year relationship. And I believe it's really important for the GPs to add real value to the founders. And if the relationship isn't good, they can't add value. If there's not a good chemistry, they can't add value. It doesn't mean that there couldn't be falling outs, of course. But
Right.
you don't know that in days or even weeks. You know that over the course of 4, 6, 8 weeks. I have one fund, love this fund. The median for their fund two between the time that they met the founder to the time that they committed was 14 months.
Wow.
For fund three, the median is 80 months.
8-0.
80 months
Well, that's
from
because
the
they have so much history of the deals they passed on and deals they did at that point, right?
And also in this case, it's embedded. The firm is embedded inside of MIT's Media Lab, and so they're meeting with.
Right.
They have really deep relations with the faculty and with
Yeah.
the student body, PhDs and otherwise, and so it creates that. And I'm using that as an extreme example. That's extreme, but the longer you get to know a founder, the better you know if there's a fit. Specialists. This is back to the specialists versus generalists. If you're a specialist, you understand the pain points that customers are facing. Going to the stewardship piece, you typically are introducing potential customers to the portfolio company both before you write the check as well as after you write the check. So you're adding real value. These are the kinds of things that I
The
think.
blind spots too, right? Like when I invest in a B2B SaaS company in an area that I was an operator, especially like this ad tech company I was telling you
Yep,
about. It's like I know the blind spots. So I'm sitting there telling them the blind spots.
yep, yeah. Like
It
before we got on the podcast, you literally laid out the biggest blind site you saw immediately.
Yeah, I just
That.
knew it
Like,
immediately. I'm like, here's something you don't know that I've known for a decade, because I saw it. I saw a slow motion train wreck at a unicorn I was at, and you don't know
right,
about this.
right, exactly. And so to me, that's why specials are so important. Now,
Yeah.
if you are
I
a
agree with this actually
firm,
because, where I've stepped out of my lane and I've gone to consumer whatever, blah, de blah, or hardware, blah, de blah, these are not my areas. And I've pretty much always failed. Like out of
yeah,
160 companies I've invested in over the years, I've had 5 or 6 shutdowns. They're all some variant of hardware or consumer. I'm like, that's just it's not my lane. It's not what I know.
there are very large generalist firms that are very successful. I think that asset size is an enemy of returns, and
Right.
they wouldn't take my money, the minimum size
Yeah.
check, lots of things. But
Right. Right.
if we're talking about this subsector of the asset class, the emerging manager, sub $150 million pre-seed and seed, there are 10,000 firms. I just want to get to 45 in my portfolio, and there are 400 really strong firms in that, or maybe 500. I just want to sort of narrow it down to the conversation to those. And
Yeah.
so that's how I get there. There's some really good generalist firms out there. It's too hard to do it right as a generalist.
Yeah. I
Too much
agree.
luck, less of
Y-
the other.
Yeah, and I think I see this, as I meet other VCs and founders that are talking to VCs. I'll talk to a founder and they're like, "Oh, you get it." And I'm like, "Yeah, I
Yeah,
built this product 10 years
yeah.
ago. I built something exactly like," and they're like, "Oh man, you're the only person I've talked to this fundraising round that actually gets it."
Right. And that's who I want to invest in. People who have those conversations with founders
Yeah.
in areas that are large enough to drive outsized returns.
Right. It's a big reason I didn't do an AI focused fund. I came from AI, built a bunch of AI stuff, and I was like, the aperture's too small, I thought, to generate outsized returns because there's just so many, there's only so many companies there. And I didn't think I could put together a good portfolio there. B2B SaaS, yes, that's a bigger pie, bigger aperture. And then AI is a subcomponent of B2B SaaS.
Again, it depends on your particular skill set. So there are other people faced with the exact same decision who can go narrow.
Yeah.
Because they have different networks and skills that
Right.
might create a great fund out of that thesis that is too narrow for you.
I love this point that you're making. It's a phrase I say a lot in venture. There's no wrong way to do venture. There's just lots of wrong ways. Like everybody has a unique approach and life skills and background, and everyone just has their own angle on this.
Absolutely. And so the answer to your question as to why a concentrated portfolio, if you're going to roll up your sleeves and really help a founder, it's hard to do that if you have too many companies and too many founders.
Yeah, I don't know if I agree. I will politely disagree.
No, you don't agree because you've got 100. How many
160
companies in your fund?
Yeah, 160.
You don't agree, but that's okay.
I don't agree. I don't agree. And I think a large part of how we approach it is with kind of our network, right? Historically, we were a syndicate. Now we have over 7,000 people in that syndicate, although we're primarily fund investors now. But it's that network that actually enables me to scale my time and scale my impact with the founders. I get a monthly update, right? Or maybe it's quarterly. And it takes me 5 minutes to figure out what's going on and who can help, right? And so, you multiply that by 100 startups, 160 startups. It is a lot of time, but it's not that much time. At some point, I will have to hire somebody, like a portfolio manager, somebody who's an operating partner that focuses on that and figures out who on Team Ignite can help and plug in the right, advisors, programs, partners, resources. I haven't reached that yet. I'll probably get there in a fund or two, but yeah, that's how I think about it.
Well, it also depends. I mean, so Brian, what you also said is you have this massive network of people who are willing to help when you ask them to do that.
Yeah.
Like you measure it in the thousands.
Yeah.
Right. Of people who you will send them a note saying, can you help here? And those people will say, okay, and will help. And they're good.
I'd like to think they're all good, but yeah, most of them are good.
Well, otherwise you wouldn't be sending them stuff. That's really rare to have thousands of people who will answer an email and help.
Yeah, and it's not. I mean, I would be lying if I said all 7,000 would answer an email tomorrow, but there's a good portion of those that would. Yeah.
No, and so it's a real. I mean, so in terms of quality of network, that's a really strong network. Now, when you put yourself into someone sitting on my side of the camera as an LP, and I go and meet a GP, and every single GP I know, every single one of them says, I have a great network. And they'll actually, and many of them will show me a slide with the pictures of people and logos of where they work and to try to demonstrate how great a network they have, not just to me, but to all people sitting on my side of the camera. My ability to judge the strength and depth and breadth of that network is really low. And so even if I'm talking to founders that you've invested with, when I'm talking about eliminating potentially good GPs from the universe that I am interested in investing in, this is a really good example of it. I will eliminate those that are investing in a large number of companies because I can't validate how much value they are really adding to a company compared to somebody who only invests in 5 or 6 or 8 a year.
Right. I think the way I approached it, and the reason we called it Team Ignite, it was always about the network. I mean, when I got started, I was investing via other people's syndicates, and I was like, okay, well, how do I want to do this? It was originally a syndicate, 5 years ago before I started raising funds. And, my wife says she came up with the name. That's a family disagreement, but I think I'm pretty sure I came up with the name. But
is it a community property? You live in California, it's community property.
Yeah, it's half hers anyway. Exactly. So we were trying to think about like, how do we go about doing this? Like, my wife ran product marketing teams, I ran product management teams and BD teams at the two biggest clouds, and it was like, well, I've never been a unicorn founder, right? I've tried to start my own companies. I had a small business with like 30 employees, but what am I going to tell a founder, right? Like, hey, I built some stuff. I haven't been in your shoes, right? And so let me find the people in my network and bring them in and try to systematize that in a way
Mhm.
where I can
Mhm.
connect you with the right people. And that's what I try to do every month when I'm looking through all the updates, right? And it's a lot of updates, is who can help here? Like,
Mhm.
and I'm actually starting to use large language models with RAG and stuff to basically say, okay, who in my 18,000 connections on LinkedIn or my 7,000 database of Team Ignite, who can help here? And there's actually about 40 partners that have signed up. These are service providers, right? They consult on setting up sales teams, or they consult on recruiting, or you name it, right? And these are the service providers who actually do charge startups.
Mhm.
But then there's like the long tail of advisors and people who've been there, done that.
Yeah, no, it sounds like a great model. It makes sense for you.
Yeah,
Totally.
it makes sense for me. It's not the right way. It's just my
Well,
way.
it's
Yeah.
it's a way that makes sense for you that can drive outsized returns. Absolutely can.
Yeah. Yeah. That's interesting. So did we get through all the way through the rubric? Let's summarize it again, because there's like lots of questions in there.
Okay, so first point was investing in spaces where they're relatively inefficient.
You made a point where that's not actually the case anymore. 8 years later, there's thousands and thousands of firms filling every niche, and there's
Yes,
YouTube videos and podcasts like this that talk about this stuff, and there's there's not a lot of information asymmetry anymore.
correct. Unfortunately, yeah. I mean, like whether you're investing in Nigeria or in Indianapolis or in space or in deep tech or any of these other areas, there are lots of choices for founders to take capital.
And then what was the next part of the rubric?
The next part was the experience, 5 years of operating / founding
Yes.
experience, 5 years of investing other people's money experience.
Now, is this running funds, or could it be SPVs, or
Totally SPV syndicates are great.
yeah,
It could be as a corporate VC, lots of different possible ways of doing that.
yeah.
What it
It's interesting.
doesn't include is $25,000 angel checks.
It's kind of like you wrote a bunch of checks into a bunch of random startups. It's a little different when you're running other people's money, I think, versus yours. I'll run into angels all the time, and they're like, "Hey, you should look at this deal." And it's always an awkward conversation, right? There's somebody on Team Ignite, writing their own angel checks. They're like, "Hey, Brian, you should check this deal out." And I'm a pretty high volume investor, right? I'm doing 50 a year per fund, 2 active funds. And so I'm writing lots of checks. And I'm like, I wouldn't invest in this. And it's always an awkward conversation because they wrote a 25K check.
Right.
And they're like, "Hey, you're going to invest in this?" And I'm like, I'm not. And here's why. I think that's what people don't realize if they're writing angel checks is you're not looking at 500 or 600 deals a month like I am, and only
Right.
investing in a handful. I write a check every week or two, but that's out of 100, 150 I saw that week.
That's right.
And angels just, and it's really interesting. I think, over time, I think it is 5 years. I think there is a 5-year cliff here to this industry of just learning the ropes and just making mistakes. And it used to be, I've heard this phrase, it takes 10 million to make a VC. Have you heard this?
No, but I get it.
Yeah. So like throwing away $10 million of other people's money until you figure it out, right?
Yes.
However many investments that is, depending on your check size or whatever. And, we've done, like I said, 160. And there's stuff I did in that first 20 or 30 or 40 that I'm like, I wouldn't do that again.
Yeah.
A lot of those SPVs I ran back in 2021, some of them are really bad. They were really bad SPVs. And, and you learn.
Yep. So that's the second point. The third point are the 3 S's.
The 3 S's. So what were those again?
Sourcing / winning, selection, and stewardship. And
yes,
stewardship being the most important and most predictive of the 3.
That's factors. The triple click that you mentioned. Yeah.
Yes.
So you triple click into the value add. Like, how are you actually delivering value?
Yes.
And creating outsized value add as companies scale. Not just, making some intros.
Some GPs are particularly good at introducing the first 2 or 3 customers.
Yeah.
That may not be as they scale. That just mean, but like the first 2 or 3 customers could be absolutely critical. So it's just providing real critical help. It could be providing significant talent intros. It could be just the person they call to deal with the challenges that always will come up. There are lots of different ways to help founders.
Right. Yeah. And one of the things that I've learned to do is just be available to do anything the founder needs besides telling them how to run the business.
Yes.
Because I don't think I can go in there and tell a founder that's working 60, 80-hour weeks, thinking about this all day, every day, like how to run their business. So what I've learned to do is take the Team Ignite approach. And I just had somebody on my podcast today, and he was telling me all about how do you think about a product-led growth versus
Mhm.
founder-led sales versus enterprise kind of
Yep.
sales-led companies. Like, what are the stages there? How do you think about architecting that? When is the right time to transition from one to the other? These are things that I don't frankly know. Like, I was a product
Right.
manager. I did sales, I did marketing, I did product, but I'm not an expert. I know enough to be dangerous, and I know enough to like know what he's talking about.
It's more than just knowledge, though, right?
Yeah.
It's also an attitude. So the attitude you express, which is the appropriate one, is that I'm not going to tell them what to do. Even if you were an expert in exactly the question he asked you,
Right.
you can be his advisor. You can tell him what you have found in your experience, but you're not going to say, this is what you should or must do. You're
Hmm.
not going to pass judgment because you're not the founder. Someone else is. And that's not what it means to be founder friendly, to dictate to founders what to do, to tell them what to do. There are too many old school VCs, not necessarily in the Valley now, but throughout the world, they're particularly sort of in outside the US, in ecosystems that haven't quite evolved yet. There are too many old school VCs who think that they are supposed to tell founders what to do.
Yeah. But I think my point is kind of parallel to that, which is it's not only that, but it's let me find you the person who can
Oh,
help you think through this problem
100%. I get it. I
at a
get it.
deeper level. Like I recognize the problem. And that's kind of another way I do everything in my life, and including my venture capital firm, is I'm a mile wide and a foot deep on everything. Right.
Yep.
I'm skirting the edge of chaos. It's my way. It's not the best way. It's my way. And it keeps me interested, frankly. I'm a foot deep on this topic on
Mhm.
PLG versus sales led versus
Yeah.
founder
Yeah.
led. I know the person to talk to, or I have a handful of people to talk to. I've heard this before, which is this framework of for VCs, it comes down to like, okay, access, deal flow. Like, how good's
Mhm.
your deal flow? What's the quantity and quality of that deal flow? Right. And then
Right. Which,
can you
by the way, I believe is predicted by how much value you add to your founders.
100%, 100%,
So
because
that's why I triple click on that. Because if
yeah,
someone says I have this great network, I see all these deals.
yeah, when
What I
founders
do
don't
know is
hear
that if the
back from
founders
you,
rave about you, then
yeah,
they are going to send you deals.
exactly. Exactly. And that's a lesson I kind of picked up over time. If I'm always available and always trying to help, those founders start sending me more deals, and
Yeah.
then I start getting on calls and I didn't even realize they were a referral. They're like, "Oh
Yep.
yeah, you backed my buddy's startup last year and he raved about you." It's all this karma thing that you hear in
Mm-hmm.
venture capital, right? It's all this like give and
Yeah.
get. But yeah, so the deal flow, can you pick the right ones? I'd love to double click into this, right? Because the way I think about it as a GP is all right, there's something like 10,000 startups that get pre-series A funding every year that your emerging managers look at, right?
Mm-hmm.
10,000. Half of those are B2B SaaS, so I'm probably looking at 5 or 6,000. About 2% of those turn into billion-dollar companies roughly
Mm-hmm.
over time, over that 10 to 15-year period. And so logically, I would want to look at like, and just tell me if I'm like flawed in this logic, but this is how I think about it. And it's funny, we're having a great conversation because I came in antagonistic from this conversation I had earlier today. But logically, you would want to try to invest in all 2 or 3% of the top things you see.
You could. If you think that if you think that your universe is going to be consistent with the statistics, and it's 2% of the universe is and 2%, and therefore 2% of your universe are breakout companies, sure, you want to invest in all of them if you can
Yeah, so like
predict.
1 out of 50. So that's kind of how I thought about it, is like, how do I build a system, a fund, a firm, when whatever way, shape, or form I can do it, that can actually execute on that vision. Right.
Mm-hmm.
That's how I'm thinking about it as I think,
Mm-hmm.
10 years out. And how do I do it without hiring a bunch of people? Because I don't
Mm-hmm.
want to take the A16Z route
Mm-hmm.
where I have this like huge overhead of
Mm-hmm.
people.
Mm-hmm.
So how do I do that with AI and contractors and advisors and LPs?
Yep.
So
Yep.
I can keep my management fees lower as I scale. So I'd love to get your thoughts on that too. Like if I went to you and said, hey, it's not going to be 2 and 20, it's going to be 1.5 and 25. Assuming everything else is a yes, does that matter?
I don't know that that matters, but for example, and it didn't matter because I was a yes either way, but I really liked the way these incentives aligned. One GP I invested with did a 0 and 25 with a step up.
Wow.
And by the way, I hate step ups. And so I normally won't do it. It's at 0 and 25, and at 3x, I'll do, it'll be 30. And I'm like, well, but you're at zero. And
That's
incentives
cool.
have really aligned there because you know, he
But he just
there
didn't need
was
the
a
management fee.
period
He's like, I'll just take zero management fee.
exactly. And
Wow.
he didn't feel the pressure to invest at a certain pace because management fees weren't dragging. And so he slowed down for a year and a half when he felt like it wasn't a great time to invest in the things he was investing in.
Mm.
And 0 and 25, I'm like, okay, great.
Wow.
There's a real incentive alignment, but he didn't
Yeah.
need the money.
That's interesting.
Yeah,
Yeah.
solo GP, working out of his house. I've been very, very successful prior.
Right. So you got the deal flow. You're picking the right ones. You're winning them, which I'm still trying to win this one I was talking about. It all feeds into itself, was your point,
Mm-hmm.
right? It all feeds, like, your ability to add value,
Mm-hmm.
impacts your reputation and your deal flow and all of that.
And it impacts your ability to do diligence on a company because the more you've helped founders, the more likely they are to sort of roll up their sleeves and take a look at other things you're looking at.
100%. And I've gotten founders to look at deals for me, hey,
Right.
this is kind of adjacent to you. What do you think of this?
Yeah.
Yeah.
Yeah. And so that's why I believe that value add is predictive of the other two things.
Yeah. One of the things I've been doing, I'll really roll up my sleeves on a fundraise for a founder. I have one right now that's going into Series A, growing super fast, and they put together basically a sheet of all the VCs they want to talk to, right? And so I'm not doing it; my assistant's doing it, right? Which is another hack. So I'm having my assistant look through it and, like, who do I know of all these target firms that are a good fit? Let's reach out to them, make sure they're on the deal flow list, make sure they look at this deal.
Yep.
But inversely, anybody I don't know on that list, I reach out to.
Yeah, it makes sense.
Right. And I
Totally
say, hey,
makes
I got a really interesting, fast growing Series A startup that you might want to look at. You don't know me, I'm Brian. And so now I'm building that network. I'm helping my founders. I'm the VC reaching out to other VCs. So they're more likely to say yes or no, or hey, thanks, whatever, than a founder cold outreach. And then I'm building the relationship with the VCs and building that deal flow network so that I can add value.
100%. Absolutely. Right. Yeah.
Yeah. So that's a little hack I've been doing. It's working.
Yeah, it's great.
But there was a couple points that you made when we were starting the conversation before we started recording that you wanted to make sure you got to. What were those?
Sure. And it's also consistent with the first question you asked me about family office and me saying that people have to expect much longer time horizons than they necessarily expect. The other thing people need to understand is that failure is a feature and not a bug. Of a fund. A lot of times failures will happen earlier than the successes. And so, you had mentioned at some point looking at markups, and markups isn't the way to, particularly in this environment, markups are not the way to evaluate a GP. Failures are not the way to evaluate a GP. It's the successes. In a power law, it's the successes. So if you have two companies that return the fund, 4 to 6 that combine return the fund again, and everything else failed, it's a pretty darn good fund. And so, in that case, you've got more than half the companies have gone to zero. And you're still getting to a 3x gross, which is still pretty good.
Yeah.
If companies aren't failing, then the GPs aren't taking enough risk. Or there's something really wrong with the environment like we had in 2020 to early 2022, where way too many companies were getting funded and not enough were failing.
Yeah.
It's telling you something.
Kind of venture capital, I think the point you're making is you want to see outsized returns and successes, but you also want to see some failure. You want to see like, hey, you were backing companies going for it, and a lot of them aren't going to make it, right?
Yes.
But let me ask you this. So here's a hypothetical, and I asked another LP like yourself on this podcast a few episodes ago, is imagine you're looking at the track record over the last 5 years, couple funds for a GP, and you got two GPs, both 5x gross, right, over their last couple funds. So really just stellar, right? Just stellar, killing it. One GP, they both did 30 investments, so they're both concentrated the way you like. They both have the ownership targets. They check all the boxes. The only difference is one had a bunch of like everything in there was like 5x roughly, 4, 5, 6x, all their startups, all DPI. The other one had one that was like, let's call it
1,000x.
Yeah, like it grossed out to the same thing. It measured out to the same thing.
It was the winner that got you to 5x the fund,
and
everything else went to zero.
Yeah. How do you feel about those two GPs? Like, do you invest in both of them? Or do you kind of go, ooh, like how do you think about that?
It really depends. So on its own, it's not dispositive, right? I'd want to understand in each case, in the FX case, is it because they're not thinking big enough? Are they selling businesses too prematurely? It's an interesting question. If every single investment goes to FX, is that sustainable? In the same way, take the other extreme. You have one that is a massive home run. Let's say it's 1,000x, and everything else is
150x
zero.
basically, for
Whatever,
math.
whatever the
Yeah.
numbers are,
Yeah.
and everything else is zero. Is that just luck, or was there something there? And so, I don't think there's no one right way to invest in any asset class, specifically, and particularly this one. And so, you could be really good, and your style leads you to a large number of medium outcomes. You could be really good and lead you to one amazing outcome, or you could be not so good in each of those. And so the track records don't disqualify either one of them. They just both, because they are so extreme, cause you to have to look underneath and try to
Yeah.
understand whether it's replicable / sustainable.
Yeah. Yeah. It's a really interesting thought experiment. So the way I think about it, like as a GP, I think I'm more happy with the former than the latter. Like, yeah, it's always great to have like this massive success on your resume. But if I am consistently getting those 5Xs or 10Xs, whatever it is, and I'm just doing it almost every company, that means I'm really good at picking. And eventually I'm going to get lucky and have a 100X, 1,000X thing.
Yeah, no, I think it merits looking at both of them. I wouldn't choose one over the other simply based on track.
Now, imagine it's the same situation, but now it's their third fund, fourth fund, and they've done that pretty consistently now. It's more or less kind of the scenario we laid out. You got, it's consistent on both sides, right? So I guess it comes down to a preference for you.
No, for me, it would be like, all right, well, I'd probably invest in both if I get room for both.
You're
Like
consistently
if they're
doing
both
it. Yeah.
getting me 5x returns. Okay, let's be clear. 5x returns to top decile returns in any vintage. If they are consistently top decile, and I am persuaded that they will, and again, track record's not the only thing that I look at. As a matter of fact, it wasn't even on my rubric. But track record is helpful. But if I am persuaded that that is the track record they are likely to get going forward, I invest in both.
Yeah.
5x is fantastic. Like I don't care whether it's chocolate or vanilla. I like both of them.
You've watched a lot of fund managers like myself, go through their successive funds. What's a typical path for someone like me? And this is almost like a personal question. First fund, 5 million. What is the second fund? How big is that? How big's the third? How big's the fourth? And where do you see emerging managers kind of fail in that scale up, or kind of mistakes that they make?
Okay. So fund size, I'll answer that first. Is a dispersion, not surprisingly. And it also is very dependent on fundraising environment. Well, right now we're sort of coming out of it.
Yeah.
But in
Feels like it's thawing out a bit now. Yeah.
In 2023, hardest fundraising environment.
That's when I raised my fund. It was like
career.
the hardest thing. Yeah.
Yeah.
Pulling teeth.
Yeah. And so that was really hard. 24 has been hard, but not quite as hard as 23. And it's because there's been no distributions across any asset class, real estate, private equity. Like I said, no is the wrong word, but much lower. Yeah. And therefore, LPs are not adding new funds to their portfolio. So it depends on that. But the typical, I'm looking at over a 30 some odd year career. If you started at 5 million, you probably get to 10 or 15 fund two. If you've got good fund one returns, and fund two is a much easier raise in many respects than fund three, it's hard to more than double the size of your fund. I have a few GPs now who are going from fund two to fund three, and they want to go from 30 some odd million to 100 million. And, you gotta get a lot, and that will happen occasionally, but you gotta get a lot of breaks.
Yeah. I've also heard, on another podcast, there's kind of this like no man's land between 30 and 100, where like 30 is too small for the institutionals, but 100 is too big for kind of some of the, smaller checks. And so you kind of like, you end up in this thing. Do you typically see it roughly double every time? So it goes 5,
Roughly, it
15, 30,
roughly.
60, 120 kind of thing?
Well, I mean, once you get to 60, then a lot of people just say, I'm not going over 100 or over 120 if they show discipline. But it doesn't, it can be more, it can be less. It obviously depends on how, I'm assuming that you are successful at your prior funds before you sort of get there. The biggest thing in my mind in terms of scaling is the number of companies that each GP has. And so if you go from fund one to fund two, and it also depends on the period you're at, what graduation rates are and failure rates.
Right.
So how many companies are still in your portfolio where you're helping when you're doing a fund two? How many more are there now when you're doing fund three? How do you have you improved on that because you've been more efficient about scaling your value add, whether the way you described with Team Ignite or by having more routinized processes to do things that are don't require human time? Have you added a new GP, whether externally or internally and promoted? Have you added more depth below, in terms of junior people and mid-level people? There are various different ways to sort of
Yeah.
deal with that sort of growth. But you asked about mistakes and about pitfalls and challenges, and that as you go from one fund to the next, and you increase the number of companies, and also looking at the number of companies you're looking at, figuring out ways to scale the firm and getting ahead of that is really important.
It's interesting. I think about when I look at founders right now over the last 5 or 10 years, as I've been investing since like roughly 2018. I think you look at the long arc of history, you see more capital efficiency every generation in value creation. And what I mean by that is, back in the 90s.
I see it fluctuate. Different generations
Interesting.
have different levels of capital efficiency. We
Tell
may
me,
be
tell me
more
more.
capital efficient now than we were, when I say we, meaning in
Yeah.
general, than 3 or 4 years ago. But 3 or 4 years ago is the least capital efficient period in my 38-year career for founders.
Yeah. Well, what's interesting, I think, like you look at like in the 90s, it took $5 million just to get a Hello World website up, right?
Sure. Well, that's in terms of what technology can bring with the
Yeah.
cloud and modern tools. Sure. But that's different. that that's a different way of thinking about capital efficiency, I guess.
Yeah. And I wonder if the same thing will happen in venture. I've already made myself much more efficient by implementing AI and automation through
Yep.
all my workflows, right?
Yep.
And so I wonder in the future, will my agents just be reviewing the founder updates and figuring out who on Team Ignite can help and like automatically executing those
Of
intros
course. Of course
and
they will.
those asks, right?
Yeah, and so you'll be able to scale more.
Yeah.
Yeah.
Tell me more about the escalating carry thing, because this is something you see a lot in real estate. I came from real estate when 20 years ago when I washed out of Wall Street. And you see it typically 20, 25, 30, depending on hurdle rates and stuff like that. Why don't, you don't see it a lot in venture. Why not? And like, why don't you like it as an LP?
For a couple of years, you saw it way too much. And so I refused to invest in funds with a step up and carry. And I committed to one fund a couple of years ago. I went through the document, step up and carry, and I said to the GP, I'm sorry, I'm not going to invest as a step up and carry. And she's like, well, I wish you had told me that before gotten all these other investors. My lawyer said this was quote typical, which it's not. But at the time, it's
That
like
in
40.
VC. Yeah.
Yeah, at the time it was like 35, 40%.
If I'm saying, hey, I want 30% after 5X, you already said 5X would be like top decile, would be incredible.
So yeah, I'm still not interested. Just zero. I'm just not interested. And
Wow.
by the way, I've also gone to other GPs, and I generally coach the GPs where I've invested and mentor them. I've gone to other GPs and they're like, hey, you got to step up. I'm not coming. And they say, oh, well, my lawyer said it was typical, but I'll change it. I'm like, okay.
Yeah.
And so that's fine. And not because they want my money, but rather because they want to appeal to the largest number of LPs you can. So how do I think about this? So I talked about my sort of statistical mindset as it relates to investing in these funds with big dispersion. And it's across GPs and it's across vintages for the exact same GP. So if I invest with you, with Ignite, and the 2022 vintage is a 4X, and the 2025 vintage is a 2X, they might, and I put the exact same amount of money in, then they net out to 3X.
Right.
But you're not netting in terms of your step up and carry. Whereas
Mm,
I am trying to diversify across different vintages and across 45 different GPs.
right.
And so to me, I'm not getting your outperformance in one vintage does not necessarily mean you're going to always outperform. 20% carry is plenty. You will make a lot of money off a 20% carry.
Right.
You haven't, again, if you're on fund 5, 6, and 7, and you have consistently performed top quartile, sure, you've earned it. Fine. And you need to
Do
do
the
this
step up,
because
do the
this is the way you need,
25.
and this
Yeah.
is the way you need to incentivize your team to stick around because you have a bigger team than you would normally have. That's fine. But, if you're managing $100 million fund with 2 GPs, so $50 million per, your 20% carry is just fine. You're going to make a lot of money.
Yeah.
And we're going to make a lot of money together. And you're going to be able to stay in business for a long time.
I don't think you can last in this business if it's all about the money. What do you
Correct.
think about that?
Not a chance.
No way. Like,
No
no
way.
way. Yeah. I can't imagine just doing this for the money.
Yeah, so I just think you had a bunch of lawyers who are all
Right.
feeding GPs, and each of them saying lots of people are asking for it until a lot of people ask for it. But again,
Yeah.
it was really easy. I'm looking to ways to say no. It was really easy to just say
Right.
no. It's like, all right, you
Right.
step up and carry. See you.
So what do you think about check size as you look at these different funds that, the fund ones that are, 5 to 10 and the fund twos that are 15 to 20? Do you have like a certain ownership target in these funds that you look at? And
For me, so I'm not looking for percent of the fund. I will, because I write checks to so many funds, I can only write relatively small checks. And every single GP, whenever I've asked, will always waive their minimum check size for me because it could be helpful.
right,
Right. And it's easier to take a smaller check than a bigger check if you're oversubscribed, which
right,
many of the GPs now that I invest with are. But what they really want is they want my assistance. So I'm not thinking about ownership target, but they're relatively small checks.
and what are the kind of some of the ways that you help GPs?
I've been in the business 38 some odd years. It's sort of
Seen a
coaching
lot.
them.
Yeah.
I've seen a lot. It's in the same way that, GPs help founders. It's coaching them. It's saying, all right, these are the kinds of things that LPs might look for. These are the kinds of things that institutions look for. This is the kind of thing that this particular endowment looks for. This particular
Yeah.
fund of funds looks for. This is the things you could put in your data room. This is how you might want to rework these 3 slides in your
Ooh, I
deck.
saw this on your slide and this is kind of a yellow flag. You might want to rephrase that. It's all these
Right.
like little things.
A lot of conversations in the last 6 months have been around, should I push this company to exit or not? My LPs are asking for DPI and I am not, this company is growing at, growing EBITDA at 60% per annum, 80% per annum. And I've only owned it for 6 years, but they want DPI. Should I sell it or not? Should I recycle? I'm not getting along with my partner. What do we, should we think about breaking up or not? Or what do we need to do to
Yeah.
stay
It's
together?
all those little things. Yeah.
What do we do at our AGM? Should I say these things versus those things? What's the cadence of letters, quarterly, semi-annually, annually? What kinds of stuff should be in them? Like, every day is a different question, but
Yeah.
it's all about everything other than, do I write a check to this company or not? Although, again, a lot of follow-on conversations around, well, do I write checks into these kinds of companies versus that kind of company? And, I'm in like more than a dozen LPACs and I'm in a couple of investment committees. And so like, just those are ways I help. The
Right.
other way I help is particularly where I've invested capital. I've got a really good network of other LPs and I'll make introductions.
Right. Yeah, it's kind of my same pitch to founders. Like, hey, if I invest, it's not my little check that's going to help you. It's Team Ignite and my network of VCs. It's all of that stuff. It's not the money.
Right. Well, and it's very clearly not the money with me because I'm not moving anybody's needles unless it's a $3 million, $4 million fund. Then sure, every dollar counts.
Yeah.
Otherwise,
Right.
I'm not moving any needles.
Yeah. Well, I could talk to you for another 2 hours, but I've already kept you longer than we had scheduled. I'll definitely have to have you back on in the future. There's so many things we didn't talk about, and that laundry list of value add at the end there just prompted 100 questions in my mind that I'll definitely have to have you back on at some point to discuss as Team Ignite grows and we move on to successive funds. And yeah, I've really enjoyed it.
I would love it. Pleasure's all mine.
Thanks, Eric.
All right,